Thank you for coming. This is a re-recording. I had planned to record this on June 18th. It was originally aired, but my technical skills failed me. So I'm re-recording it so that the content is still available for our clients and mailing list viewers. Today we're going to talk about how there are life events that happen to just about everybody, different types of events, and how those things impact your financial picture. The goal today is to help you understand how and when you need to ask your accountant a question. We're going to talk about the way the personal tax planning system works, some of those stages in our lives that we can plan for so that we have a better financial result, or at least we're expecting the result that we get, and some final tips. And I'll take it from there. For those of you who are watching, my name is Laura Bedell. I am a CPA CMA. I started my accounting firm in 2020 after more than 20 years of working in corporate environments. What I learned in the corporate environment is that if you know what you need to know later in life, if you know that earlier, you can actually achieve your goals faster. So my goal with the firm has always been to help people, whether they're business owners or, Canadians just managing their lives, understand things that they need to understand so that they're not surprised. I do that by trying to manage your finances with you in a partnership. I do it by speaking plain English, and hopefully this series of videos that we're trying to do will help spread some word so that people know when to reach out to their accountant, because oftentimes by the time you've reached out to your accountant, it's too late. Okay, the legalese session is for education. It's intended to help you, the participant, better equipped to make decisions, basically focusing on when you need to get advice, or at least to understand when something may change in your life. You should, however, speak to your accountant, even if that accountant is me. We should speak about your individual facts before you make changes to your financial picture. I will not be answering any specific questions today. And certainly if I give an example that sounds like your life, it's still important to speak to your accountant. Do not go and change your whole life based on what I've said here today. This is just to help you understand when you need to ask questions. My goal is to protect your financial health. After working so hard for what you have built, i.e. the money you have, the wealth you've created, the family environment that you've created, I want you to be able to do what you want to do. Enjoy your life, whatever that looks like for you. Some people that's a world of travel, some people that's a world of things, jewelry, art, that kind of thing. For some people it's just more time with their families. You decide what's important to you and enjoy your life. I want you to be able to afford what you want when you want. There's nothing worse than living check to check, not knowing if you're going to have enough money next week to pay your bills, or what happens down the road when your kids want to go to school or when you want to retire. Are you going to have enough money? So I want you to be able to afford the life that you are picking. I want you to ensure your family's wealth, whatever that may look like. It could be as simple as my kids have nothing to worry about after I'm gone. That's a form of wealth. There's obviously the financial wealth. If you've got assets, investments, and you're thinking, oh, I'm going to leave all this money to my kids. What this presentation will show you is that may be true, but you need to do a little bit of planning to make sure that you're doing what you want to do. I will say that I have a philosophy that saving tax is part of our financial planning, but it's not really the goal in of itself. I encourage my clients to come up with what are your financial goals and what does that look like to you? What does that feel like to you? How will you be successful? Obviously, saving tax is kind of inherent because the more tax we pay, the less we have available for our own use. But just to sit in a meeting and say, oh, I just want to save all the tax I can, that doesn't really help give us direction. So I really encourage people to have goals. One thing that people don't seem to understand when they come into a meeting with me is that personal tax is kind of like a staircase. So I took this off the internet from a website called taxtips.ca, and this is the Ontario, because I'm in Ontario, combined tax rates. So for the first 53,000, you're going to pay 19%, and over that, you're going to go to 23. When you get to the next bracket, 58,523 to 94,29, and then when we get to all the way to the bottom, anything over $258,000 is taxed at 53.53%. So it's not to say that if your income, let's say you get a raise and all of a sudden you're making $250,000 a year, not the whole 250 is going to be taxed at this rate. You're going to work your way up through the rates. And our payroll systems will blend the rates. So it'll say, okay, based on your income, maybe we're going to tax you at, I don't know what the math is off the top of my head, but let's say 45%. So you'll pay the right amount. But what you'll find is that the staircase, will come to play as we're talking through the conversation. You have multiple sources of income. The thing is that everyone taxes you based on what you know. So maybe one source of income has you here, so it's blending you on the first three, and the next source of income, it says, oh no, you're only going to be in the first two brackets, so it blends you on the first two. Well, then when we do your tax return, we put the two together, all of a sudden you're up here in the fourth tax bracket. So nobody taxed you enough because they were blending based on you ending up here or here. So it's up to you as the individual saying, I have a more complex tax situation. I need to make sure I have additional tax taken off. And that's part of what today's presentation is to help you know when you have to ask those questions. We're going to talk a little bit about how to ask your accountant a question, and it's really a little bit of a what not to do as well, at least in my experience at my firm. So I often get a message that says, hey, quick question for you. And realistically, there's no such thing as a quick question, because if your accountant is going to give you advice based on you, they need to have more information than that. Where are things right now? What is changing? And what is your goal besides saving tax? So even if I'm doing your tax return every year, we have an interaction that lasts, we'll call it a couple of hours a year. You send in your tax information, I prepare the returns, I give you a result, and you come back the following year. That's really not enough information for me to really know what's going on. I don't know what you've worked out with your financial planner in terms of, retirement and so forth. So I can provide general information like, no, don't worry, that insurance policy that you're about to get the money from probably isn't taxable. RESPs, the contributions don't make a deduction off of your tax return. Those are very simple mechanical questions, and those maybe qualify as a quick question. But in my experiences, that doesn't really answer the question you should be asking, right? What can I do? This is the decision I've made. Is there something more I need to understand? Okay, so please keep in mind, there is no such thing as a quick question. And if you're already at the point where that tax return is being prepared and something happened, say 6 months ago, it's kind of too late. Really, talking to your accountant needs to be a proactive thing. This is about to happen, or this might happen. I'm thinking about doing this. Those are great times to reach out to your accountant, because we have times to say, okay, but just so you're aware, if you do this, think about this, and so forth. By the time you get to the tax return, it's, okay, so you did what? Okay, so based on what you did, here's the tax you pay. Really no opportunity for us to talk through the implications. Why an email is not enough. This is, in my opinion, a good accountant, a great accountant. They're always going to have lots of questions about your situation before giving you advice, which leads to a long chain of emails. It's nearly impossible for me to know if you're understanding me via email. And I've had lots of examples where I've said, okay, here's what we're going to do. Here's your plan in writing. Do you want to have a call? Nope, I've got it. I understand. It's great. And we do the tax return and they're like, I don't understand. Well, you said you understood. So I try to make sure that we get live, and by live, I mean virtually, on a call, because that allows me to do a few things. It allows me to look at you and try to understand what you understand. It also allows me to get some time together to get the information that I need. I mean, you're asking for financial advice, and everybody hates numbers, and nobody liked math class. Some of us did, but how can I give proper advice if I don't go away and do some math and figure out some numbers and figure out what's going to work for you? The other thing I'll say about emails is they're not planned. They just show up randomly in my email. I don't know they're coming. If they do that and then you want an answer quickly, that doesn't always jive because A, I may or may not have the information I need to actually do a good job for you. But then B, what other things are going on? If we have a planned call, then we can discuss what the timeline is for a proper answer and discuss, you know, not only what your timeline is, but what my timeline is, and really to give you an understanding of, are you going to get a report or do we need to have another call, and really just work out the expectations. Email might be a good starting point to say, hey, here's some things we need to talk about. How do I book a meeting if you're not sure? But I wouldn't say it's always feasible to expect that you send an email and then, you know, okay, but what's my answer? Okay, so now we're going to talk about the stages of our life. When we're financial planning, the reality is that there are stages in our lives that we can know about and expect. And there are obviously also ones that we don't know about and expect. You know, people don't generally plan for the eventuality that they're going to get a terminal illness or that their spouse is going to leave them and there's going to be a divorce that maybe one person wasn't expecting. There are things that we can't plan for. And knowing that life events changes our financial health is kind of the best advice I can give you at this point, is that if something big changes, you need to stop and think, okay, what's this going to do? And then you might have to reach out to your accountant. But there's certainly lots of times where there are, in fact, ways to plan. If you're in your life planning to have children, or maybe you've just had your first child and you want to pay for their education, how are you going to do that? Most of us need to plan for retirement because most of us don't plan to work until the day we pass. And realistically, all of us should be planning for the day we pass away. What I'm going to do now is I'm going to take you through some life events. I'm going to do them in an order. It's not necessarily the order it's going to happen in everybody's life, but certainly if we talk through what kind of the hiccups you hit with these various events, hopefully you can use that to extrapolate for your own life, something similar, or maybe an event like the ones I'm saying, and have you created that plan? The order doesn't matter. It's really a matter of being aware and having that plan. I started with graduation. So graduation I started with because that's kind of your first full-time grown-up job. I'm assuming at that point that your parents are less involved. You know, certainly when we're working through post-secondary education, our parents still tend to be a little bit involved. Things that may or may not exist on graduation is, do you have a student debt? Do you have leftover tuition credits? Both of which create a tax impact, one much better than the other. Where are you living? After graduation, did you move out and get your own place, or are you still living with your parents? Because now you've got potentially a lot more income. Where are your expenses? And what's going to happen? You know, you've taken this first full-time job. You know, very few people, unlike, say, my grandparents' stage of life, work for the same company for their whole career, right? So are you planning to change jobs? What would that do? Are you planning to take on something else? Are you getting married, having a child, purchasing a home? All of these things. What do you plan to do next? Because that will help us determine what kinds of things we want to figure out in terms of how are you going to financially afford that next stage? But in addition to that, what kinds of changes can happen to your tax return that you may not be used to? I mean, a lot of students really don't pay taxes, and you graduate if you don't have those leftover tuition credits and maybe you don't have student debt. You know, how do you make sure that you've got the right amount of tax being taken off? Do you only have the one job, or are you also doing something else to try to get some experience so that you can get that great job? Maybe this first job after graduation is just a keeper. So really having those conversations to understand so that you're not sitting at tax time saying, oh, how can I owe $3,000? As an example. Okay. Your first home. Did you buy it or are you renting? A lot of people assume that your first home is a purchase. Well, it's not necessarily the case. Some people choose to go out and rent. What does that look like for you? How are you affording to pay it, and how does that impact your down payment? Obviously, in the case of a rent, the down payment is more of that first or last month's. And in terms of purchase, it's actually the down payment. And we have lots of different vehicles. You can take money out of an RSP. There's the FHSA. I always say that wrong. The FHSA transaction savings account. Do you have a TFSA? What did you do? Do you have to repay? If you took it out of your RSP, you do. How does that look for you? So really understanding that piece, understanding it before you hit that part of your life is really important. It's important to know how you're going to do this so that you can, in fact, make your goals. Okay? Your relationship. Are you married? Are you common law? People shy away from that. They're like, oh, it ruins my taxes. It actually doesn't. There's really no such thing as a joint. I'll throw this out here. I get a lot of people, well, we don't want to do a joint tax return. Well, a joint, it's not like you come down to one tax return. You have a couple of returns individually that just say, hey, we're married. It does impact your benefits for sure, but it also gives you some benefits like you can share income. There are deductions that you can share, and these types of things can actually improve your tax standings. So your relationship matters. If you're purchasing the home, going back to the first home, if you're purchasing that with somebody, that first time home buyer's credit can be shared. Do you want to share it, or does just one of you want to claim it? Do you both qualify for it? These are all things that we would ask for in advance of the tax return. Okay, having children. Well, what I'll say this is, we don't tend to make the decision to have children based on things like the tax implications, right? But, things that, come to mind is, can you afford them? There's activities, there's daycare. How are you saving for their education, and what are the tax implications for that? Parental leave is one where I get a lot of people asking questions about, why do I owe tax? I've been on maternity leave. And if you remember at the beginning, we talked about the staircase and how if you have two different sources of income and each are taxing you based on their tax bracket, they may not realize, or they don't realize because you haven't told them, that actually when you put those two incomes together, you're going to be in a much higher tax bracket. So parental leave is one where I'm often saying, sorry, but you owe. Now, that also depends on what month your child was born, which is a silly thing to think about. But when I had my first pregnancy, I had twins. My children were born in August. It was a very different tax situation for me because I had had 1 year where most of my income was my job, and I only had a few short months of maternity leave. The following year, I had a lot of maternity leave and a few short months of employment income. So those 2 tax years, even though it was the same situation, different tax results. My third child, my second pregnancy, he was born in January. It was almost like night and day. I finished a tax year and then I did a tax year on EI. So it was a very different. So these little nuances are important for your accountant to understand so that you can plan for what you need to do. Do I need to put some more money aside for tax? Do I need to ask EI to take more money off? These are important things that you have to think through. Okay. Now those children have their own post-secondary education. Did you save for it? If you did you do an RESP to take advantage of the grant? Did you do something else? Who's going to pay the tax? The reality is that if you did the RESP, by the rules, the kids have to take the taxable parts into their own income. That actually works out not too bad. They're in a lower tax bracket than you, let's be honest. And they've got the tuition credits, and the tuition credit rules again says that they have to bring their tax to zero before they can pass anything on to you. So in a world where I have a choice, the kids are going to take the tax, but realistically, some of the rules mandate that they do. So the mistake that people make is that they take only the grant out. They don't take out any of their own principal. So now that, you think of that first year of school, maybe you had to put away $8,000 or $10,000. So you pulled out $10,000 worth of grant. You're thinking, well, that's okay, they're going to get the tuition. But in that first year, that tuition credit really only covers September to December. So even though you might have taken out enough money to cover the full year's tuition, the tuition credits don't line up. These are the types of things you've got to, kind of slow down and talk to somebody just a little bit, just to understand it. And a great time is that when you're doing those tax returns of the last year that they're in high school, before they're going to start post-secondary, right? We're talking in April, May. They're starting school in September. Let's have a conversation. There's things that are children's lives that sometimes for some families are also milestones. When your child gets married, are you going to pay for that? Are you going to throw the wedding? Are you going to help them contribute to their down payment for their first home? What about their children? Are you going to help them pay for their school? It doesn't matter what your choice is, but you have to know what kind of parent you are and what your plans are. How are you going to pay for this, and how are you going to save the money? And are there ways for you then to save tax? In some cases, the answer is just no, you're being generous, and that's okay. Okay, now you're going to retire. How are you going to pay for it? Have you been contributing to RRSPs? How were you employed throughout your life? I will often give very different advice to people who are employed by a different company, who are self-employed, and by that I mean that they're a sole proprietorship or maybe a limited partnership, or do you own your own corporation? My answer changes depending on what your situation is. So that's part one, is how are you even getting this money, and how have you been contributing? Are you doing it with after-tax dollars? So in the case of where you're employed, and a lot of companies offer this great thing where it's like, if you contribute 2% of your pay into an RSP, we'll match that 2%. So you're getting 4%. That's a great plan. The thing is that when they do that, they take the tax savings at the time of payroll. So you're bringing home more money. When you file your tax return, however, I don't have any tax savings for you. You already saved the tax. And this worked out great until you change jobs or leave that company. And then you don't have the similar matching program. And all of a sudden, your last year of employment, I do your tax return and I say you owe so much money. And that's because your January and February contributions were used on last year's return. But your T4 this year is short the tax. People don't realize this is happening. So even something like, how are you saving for retirement, can impact the tax return, because just changing jobs, a life event that you were part of, changed your tax return. You didn't even know it was coming. But now you're at the retirement. How much money do you need to save? That's not a me question. That's your financial planner. And I don't know how much you need to save. So I get a lot of questions like, how much money should I contribute to my RRSP? I don't know. Where's your plan? What are you doing? I can tell you that if you contribute $5,000, that I think you're going to get so much tax savings. And I'm going to do that based on a quick math of how much income you made last year and what kinds of deductions you had. I don't actually know at that moment in time if your income has changed. But I should not be the person determining how much you contribute to your RRSP if your RRSP is the way that you're trying to save for retirement. And in my opinion, saving in an RRSP is a great way to save for retirement, but it's not. What I find clients talk about is it's a tax savings thing, and it does provide tax savings, and it may provide good tax savings depending on your situation, but don't make the contribution based on tax savings. Enjoy the tax savings. Maybe use that kind of net number to figure out affordability. That I understand. But to figure out how much you contribute just based on the tax savings is backwards. You need to figure out how much you need to save and how you're going to get there. The tax savings are a bonus. The other thing about retirement is that you have some great advantages in income splitting. If we think back in the old days when the man made all the money, there was some tax rules brought in, allows the wife to take some of the pension income, or also works for RIFs. You can do that, and certainly that's a great balancing act. It does impact, though, one of the partners passes away. So we'll talk through that in the next moment. And again, what does your retirement look like for you? How big do you want to live? Are you going to be the type of retired person who sits out on the lake and fishes their time away? Or are you going to be traveling and on cruises and stuff? All of this stuff determines how much money you need to actually have set aside. And I don't do that math. Your financial planner does. Now one of you have passed. I'm assuming at this point that you're in some sort of married or common law relationship and one of you has passed. I guess first of all, do you have the knowledge to manage your finances alone if your partner goes? One mistake that people make is that you'll have people come to me and just like, well, what about this one? About this? I don't know. Even though one of you may have a fortitude towards taxes and financial stuff, keep the other one informed. Okay. A little education session, a little envelope to say, give this to the accountant, whatever it looks like in your situation, make sure you know that. Understand what the tax implications are. Many things when you're in that married or common law relationship just goes from you to your partner, no tax implications. It kind of works out nicely. But what if you had been income splitting all those years? One of you was earning a pension and now just one of you is all left. Well, that pension split that we were doing to save taxes, right? Because what the pension split does is it moves you down that staircase that I had talked about at the beginning, right? So instead of one of you earning 50,000, two of you earn 25, boom, it works out nicely. But now your partner's died. Unfortunately, now you have to pay the full 50. Well, how does that work given your other incomes, right? Because now you're collecting your income plus a bigger part of the pension than you're used to claiming. That has an impact. I've had many widows and widowers suddenly owing money that they never owed at other parts of the retirement because of the inability to split their pensions. Okay, and then what happens when you pass away? So now you've taken everything and now you're leaving it for your kids. Depending on what kinds of assets you hold, your kids or your beneficiaries, whoever they may be, maybe it's not your kids, maybe it's your next door neighbor who you really like, but whoever it is, they're going to have to pay tax on it. On the day of your death, it's as if you sold everything. Now, some things have no tax implication. If you sell the house that you're living in, guess what? That's tax-free to you. You've passed away. Your final return is nice. But now they actually have to sell the home. Let's assume that's what they're doing. And let's say on the day that you passed, the realtor estimated that your house was worth, I'm going to use easy numbers, $200,000. And then by the time you got the estate settled and the house actually sold, maybe it's now $250,000. Well, guess what? $50,000 is going to be taxed because that's no longer a primary residence. It's an investment property. So these are the things we have to think about. Your RRSP, my mom is guilty of this as well. You've got RRSP money, it's sitting there, and you're just taking it out a little bit of a time as you have to, because the rules eventually, when you turn a certain age, says convert it to a RIP, take money out every year. But if you've got a lot of money in your RRSP, when you pass away, you fly up that staircase of taxes. So you could, depending on how much you've saved, 53% of it could be taxed, 53%. So you think you're leaving your kids, for the sake of a big number, $500,000, but a lot of that could end up going to tax. So it really is important to understand what you own and how it's structured so that we can figure out, is it structured in a good way to minimize tax? Because guess what? When you're retired, your life is less expensive. You're not paying usually for your house anymore, for fancy cars. You're not commuting all over back and forth to work like you used to. Your kids generally aren't costing you as much money. They're grown up, moved out of the house. They got kids of their own. You're not worried about it. You're kind of at a good stage of your life in terms of your finances. You might be down in a 30% tax bracket. Well, if you take extra RRSP money, as an example, out every year and control how much you take out so that you're not repaying your old age security, because that's one mistake I've seen, but also to control the tax rate so that you're paying at 30% instead of the big 50% that would happen at your passing, you can throw that money in a TFSA, in an envelope in your mattress. I don't care, because once it's out of your RRSP and the tax is paid, giving that to your beneficiaries, whoever they may be, at whatever time you decide, is tax-free to them. So just keep that in mind. Nobody likes to talk about their impending death, but it really is an important conversation to have, just so that we can make sure that you're leaving behind what you want to leave behind. when people do book calls with me and they want to talk about stuff, the things that they do is, so my friend told me this, they do this, and it works really well for them. I want to do that too. Or people say, so I asked AI and AI said I should do this. And so that's what I want to do. What I'm going to say to you is first of all, not everyone has the same stages of life. So there are things that might make sense for them and that they really enjoy and they think is a great idea. It may make sense for you. I'm not saying it doesn't, but I don't know that because I don't know your friend's situation. What I can do is assess your situation and see if a similar strategy would apply to you. And I don't mind clients coming to meetings informed or knowing what kinds of questions they want to ask, but just be open to the fact that things are different. Business ownership is one that really changes how I plan for your future because there are different vehicles that you have available to you that they may not have. And the structure of your business also impacts that. So, and how many businesses? Some people, they have a holding company and they have operating businesses. Some people just have a simple operating business. Is it a corporation? Is it not? Are there partners in that corporation? Who are those partners and which class of shares? There's all kinds of things we need to understand. There's also your general financial savvy and your risk tolerance and how much time you have to save. I mean, if you come to me with a great idea and you're 55 years old hoping to retire at 65, you've got a 10-year window to achieve your goal. How much have you already saved? How risky are you prepared to go? And do you really understand what we're doing? Versus a 20-year-old who wants to retire at 65, they have a much bigger time window. They might be able to undertake more risk because they've got more time to save. And the reality is just plain and simply, we are all different. And so I do encourage people to get themselves educated, watch videos, talk to people, find out what other people are doing so that you can start to get an understand their experiences. If you want to Google, there's an article that you can find. It's a Burlington couple who passed away in the same year. I think that's a good Google search. Read what happened to them because unfortunately, I believe it was the wife passed away at the beginning of the year and the husband passed away towards the end of the year. And they're just, because it was in the same year, it compounded their situation. That family owed a lot of tax because the parents died earlier than they had planned. I could tell from some of the things they hinted at the article that I think the family actually had a plan and that they were working towards it. They just passed away sooner than they were expecting. And it cost them a lot of tax. Now, these things happen, but as the rest of the world, we need to learn from these things. So understanding why that triggered tax. And those are all great conversations to have with your accountant and your financial planner. Let's talk about plans changing. The analogy I always use is if you're driving somewhere, you're on the highway and traffic slows down, boom, there was an accident. You have to make a choice. Am I going to stick on this highway knowing that I am going to get there slower? Or am I going to jump off the highway, go down some other road, get back on the highway down the road, and hopefully get on the same path? Or forget it, I'm not even going to worry about this highway. I'm going to stay off this other route and get to my destination a different way. Financial planning is exactly the same way. You need to know where you want to be. You need to know where you are. You need to have a plan on how you're going to get there. You need a way of knowing if you're hitting your goals. If your plan is to save $1 million in 5 years, I would expect you're not going to wait until year 5 to see if you saved $1 million. You're going to look periodically, whatever that periodically is for you. But let's say at least once a year, you're going to say, okay, so I'm up to 250. Great. I'm up to 600. Great. I'm up to 700. Great. Oh, my 700 dropped to 600. Is that a problem? Like, these are the types of analysis you need to do. You don't have to be a financial person to really undertake those. You just need to have a team of people, your financial planner, your accountant, who know and understand the plan, who can help you determine if you're on the right path. Think of us as your GPS for your financials. We want to be proactive versus reactive. The whole reason I'm educating on this is because I think I said this at the beginning. If you're working on your tax return, it's too late to make any meaningful change. People will talk about, oh, I have this great accountant. She saved me lots of money. And that possibly happens. But when we're preparing your tax return, we're really looking for things that you already did that we can exploit to save you taxes. So the best way to save taxes is to find out what kinds of things I need to do and can I exploit them, or are there things that I'm willing to do so that we can exploit them. But really, the whole goal is to get you to a place where you're meeting your goals based on those life events. Okay. Tax planning doesn't mean that you're not going to pay tax. I get a lot of people saying that. I don't understand why I'm paying tax. That's why I hired an accountant. Well, because we all pay tax. But the point of the accountant is to help you minimize your tax. And for me, it's a long game. I always talk to clients about the fact that we can, talk about your 2026 return, your 2027 return, but if we save tax in 26 and 27, what is that going to do to your 2050 return? We need to have some sort of idea. Things that I want you to be aware of is that under taxation happens when you have multiple sources of income. So if you're a teenager working several jobs, a student working several jobs, that example we gave earlier about maternity leave, if you've got EI and your employment income, that's having multiple sources of income. If you're retired and you've got a Canada pension and old age security and maybe a company pension, that's several sources of income. If you're an astute investor and maybe you have a great financial planner who has a non-registered, i.e. not in your RSP portfolio for you, that's generating lots of income, guess what? That's lots of income. Are you in a situation where you're going to have lots of income? Because whenever that happens, you're going to be undertaxed, almost guaranteed, unless you intervene. If you have a spouse or a common law partner, now you're introducing the concept of splitting. So we have ways that looking at the two of you together, combined, we're going to move money around so that as a couple, your taxes are minimized. I will say your government benefits will go down, right? So you'll get less, child tax benefit if your show is married versus if your show is single. And if you're legitimately single, then you deserve the higher child tax benefit. If you're married and not reporting it, that's not proper and that's a crime. But beyond that, your benefits will go down. So the important thing there is to say, okay, I've had a life event. I got to go on the CRA website and tell them so that they stop paying me more benefits so that I don't have to repay them back. Just understanding that stuff really just helps you save money in the long run, because if you have to pay it back, if it's deemed that you have to pay it back later, they're going to charge you interest on it too. So don't give them the interest. Be proactive. Say to them, hey, I just got married. They'll reduce your benefit. Yeah, it'll stink, but at least you won't have to pay interest on the money that you have to pay back. And then we have this concept of the deemed disposition. Happens a lot when somebody has passed, but basically the rules say you sold something even when you didn't technically sell it. It happens on the day that you died, and you need to understand your stages of tax in order to really help you make the right decisions. Your goals drive the decisions, not the taxes. The size of your refund is not a measure of success. I had an example where a person, for the sake of argument, the way she was managing her income, she'd get about $1,000 a year back as a refund. Great. Then she retired. And then when she retired, that year, her refund was only about $500. And she's like, I don't understand. I'm paying more tax, but now I'm retired and my income's lower. And I was like, you didn't pay more tax, right? So we went to the tax return and I said, see, last year you paid, I can't remember the number, but let's say for a big number, $50,000. This year you paid $30,000. You just didn't overpay as much tax. You used to overpay $1,000 this year in tax. This year you only overpaid $500. You still paid less tax. Remember that the refund is not the measurement. The measurement is really how much tax did you pay. That's an important point to remember too. Okay, my final tips and takeaways. Set goals. Know what you want to do, what you want to achieve and plan, and figure out how you're going to get there. I am happy to work with your financial planner. I've had several calls with clients where they're like, can we just, the three of us, get on a call? And we do that. It helps me understand what goals they're trying to achieve. And it also helps them understand whether or not I have a plan. And the truth is I don't do long-term personal financial planning, but what I will do is help guide you and help you measure whether or not you're hitting that goal. And then once we understand that goal, then I can say, hey, did you know about this, or this, or this? That will help you save tax along the way. And guess what? That will help you hit your goals sooner. So it's really great to do that introduction for us to say, hey, let's have that talk. And certainly I know financial planners, if you don't have a financial planner, maybe you should. I can do an introduction to some people that I already know do a good job of taking care of their clients. I pick my partners based on how they treat their clients, not how much fee they make, so to speak, right? So if they might have a slightly higher fee, I don't know, but I know that they have your best interest at heart, and that's how I put my clients towards planners. You got to measure your progress. So when you plan something, you have to have a way of knowing whether you're on track. Okay, are you on target? Are you going to meet your goals? So the plan is to avoid side effects like taxation, but the plan is also to help you see if you're going to get where you're going, right? Because if you had planned to retire at 55, you don't want to get to 55 and realize you don't have enough, right? So you need to have that. And if you're not going to have enough, to be able to hopefully intervene early enough that you can, maybe not have to work till you're 60, maybe you only got to work till you're 57, right? That's the goal. Okay, taxes are a side effect and they're not a goal. So please don't tell me your goal is to reduce taxes. I already know that that's what everybody wants to do. And it's certainly part of the measure, but it's not even like a year-to-year thing. It's a long-term approach. So like I tried to allude to earlier, putting a bunch of money into an RRSP is a great thing. And you save money every year. Let's pretend that you're just contributing what I call after-tax dollars. So you're taking money out of your savings account, you're dumping it into an RRSP, you've already paid the tax. So guess what? When I do your tax return, you're getting a great big refund. You're happy, I'm happy, all's good. What I would suggest is that if you're not going to pull that money out on retirement in a tax efficient way, then saving all that tax up front does nothing. You're going to more than pay that at the back end, partly because tax rates go up, and partly because if you're not pulling that money out in a systematic way, you're going to hit that 53.53%. It is a side effect, not a goal, and sometimes we want to take I would say always we want to take a long-term approach, but sometimes that means that I'm going to say to you, we're going to pay a little bit right now to save in the future. That's why those conversations can't happen when you're preparing the return. You have to figure that out. What I'd say is don't let the tail wag the dog. In other words, you have to decide what your financial goals are. You build a plan, and then we will help you minimize tax if that's what we need to do in order to achieve your goals. I mean, if your goal is just to put all of your money into a mattress, really not a lot I can do for tax for you, right? So it's really about understanding what you're going to do. And for the most part, that ends my presentation. So when I gave this live, we turned it over to questions so that people could, clarify the information. I do want to stress, don't listen to anything I said today and say, oh, I'm going to go and I'm going to forge ahead and create and do this, and this, and this, and I'm going to shadow my RRSPs because Laura says I'm going to pay too much tax on that. Please don't do that. Please stop. Speak to your accountant, speak to your financial planner, see if you're on track, see if you have your goals, really define those goals and really define what information you need to have together so that people can help you with your goals. And certainly, there are things that, life insurance policies and, other things that you can do that impacts this. You have to have a total picture. So I would encourage you to take some time to document what you have, document what you're trying to do, and then sit with people who can actually help you with, okay, and this is what, it may look like for you. Don't be afraid to sound uncertain. I don't want to say sound dumb, but that's what people will say to me. It means, I don't want to sound dumb. Well, you know what? You didn't go to school for this. I did. And when I go to my car mechanic, I sound really dumb, but I also ask a lot of questions because I know I don't understand. So please ask those questions and make sure you understand. That is going to conclude today's video. I hope that you find it helpful. If you have any comments, please let me know. Would love to hear from you. We are going to plan to do some series like this. I'm hoping that the next time I do a live presentation that I don't have to record the session separately. So the dynamic may be a little bit different, but the goal really is to help you know when to ask questions. And I hope that this did it for you. Thank you very much. Take care. And if I'm your accountant, we'll talk soon. If I'm not your accountant, please reach out to your accountant. Have a great day.